The narrative of China's debt trap diplomacy in Africa has become a familiar refrain. It conjures images of Beijing deliberately ensnaring nations in unsustainable financial obligations, poised to seize strategic assets when defaults inevitably occur. This potent story, however, often simplifies a far more intricate reality. While the risks associated with burgeoning debt are undeniable and warrant serious scrutiny, the dynamics at play involve a complex interplay of ambitions, benefits, and indeed collusions that extend beyond a straightforward tale of predator and prey. Understanding this relationship requires a closer look at the motivations and gains for all parties involved, particularly African elites and Chinese commercial and state interests. The truth is, these large-scale infrastructure projects, often funded by Chinese loans under the expansive Belt and Road Initiative, frequently serve the immediate interests of both the providers and the recipients at the governmental level. For African leaders, these ventures offer tangible symbols of progress and development. New roads, railways, ports, and government buildings can translate into significant political capital, demonstrating a capacity to deliver and modernize. Simultaneously, Chinese companies, often state-owned enterprises, secure lucrative contracts, expand their international footprint, and gain access to vital resources and new markets. This symbiotic relationship can create powerful incentives to pursue projects, even when long-term viability is questionable. This phenomenon is not merely about grand national projects. It often delves into the realm of elite collusion. Reports and analyses suggest that the processes surrounding these deals can be opaque, creating opportunities for personal enrichment or political favoritism. African elites might find themselves in a position to steer contracts, gain access to resources directly, or consolidate their power bases through the patronage that such large-scale investments can facilitate. For their Chinese counterparts, navigating these internal political landscapes and securing the cooperation of influential figures can be key to ensuring project approval and smooth execution, regardless of the underlying economic fundamentals or broader public benefit. Therefore, to paint African leaders as purely passive recipients in these financial arrangements is to misunderstand their agency. Many are astute negotiators, actively seeking out Chinese financing as an alternative to traditional Western lenders, who often come with more stringent conditions related to governance and human rights. They leverage the geopolitical landscape, playing different international partners against each other to secure deals that, at least in the short term, bolster their political standing and deliver visible infrastructure. The debt trap is less a carefully laid snare and more a complex ecosystem where various actors pursue their own distinct, sometimes overlapping, advantages. The appeal of grand infrastructure projects for political leaders is vividly illustrated in countries like Kenya. The standard gauge railway, stretching from Mombasa to Nairobi and beyond, stands as a monumental example. This vast undertaking, largely financed by Chinese loans, was presented as a transformative project, essential for economic growth and regional integration. For the Kenyan leadership, its completion was a significant political triumph, a visible testament to their ability to deliver ambitious development goals. However, from its inception, the standard gauge railway was dogged by concerns regarding its exorbitant cost, the transparency of its procurement process, and its fundamental economic sustainability, with questions lingering about its ability to generate sufficient revenue to service its substantial debt. Ethiopia offers another compelling case study of this dynamic. The East African nation embarked on an ambitious infrastructure development drive, with Chinese financing playing a pivotal role in projects ranging from railways and industrial parks to telecommunications infrastructure. These developments were central to the government's narrative of rapid economic transformation and poverty reduction. For Ethiopian political elites, these projects were not just about economic uplift, but also about projecting an image of a rising, modernizing nation. Yet, similar to Kenya, the sheer scale of borrowing and the economic returns of some of these ventures have come under intense scrutiny, contributing to Ethiopia's growing debt burden and the subsequent need for restructuring. It is crucial to note, however, that the landscape of Chinese lending in Africa has undergone a significant transformation in recent years. The peak of this lending activity occurred in 2016, when commitments reached approximately $28.4 billion. This was the era when the Belt and Road Initiative, launched in 2013, was in full swing, with mega-projects being announced with considerable fanfare across the continent. Since then, the figures have seen a dramatic decline. By 2022, new Chinese loan commitments to Africa had plummeted to under $1 billion, signaling a clear and perhaps permanent shift in Beijing's lending strategy towards the continent. This recalibration has led to what some observers term a small is beautiful approach, reportedly endorsed by Xi Jinping in 2023. Instead of financing colossal capital-intensive infrastructure, the focus appears to be shifting towards smaller, more targeted loans, often under $50 million. These are intended for projects with more immediate local impact, such as improving water supply systems, investing in renewable energy schemes, or supporting agricultural development. This change reflects a desire by China to reduce its financial exposure and manage risks more effectively, while still maintaining its engagement and influence across Africa, albeit through less grandiose means than before. Despite the shift towards smaller lending, the legacy of the previous decade's mega-projects continues to cast a long shadow in the form of substantial debt repayments. For the year 2025, it is projected that developing countries globally will owe China around $35 billion in debt servicing, with a significant portion, approximately $22 billion, due from some of the world's poorest nations, many of them in Africa. This considerable outflow of capital places immense strain on national budgets, diverting funds that are desperately needed for essential public services like healthcare, education, and social welfare programs, and hindering responses to economic shocks or climate change impacts. Interestingly, while Chinese debt is a prominent topic of discussion, it is far from the whole story of African indebtedness. Research consistently shows that African governments collectively owe considerably more to private Western creditors, including commercial banks and bondholders, than they do to China. In fact, the debt owed to these Western financial groups is estimated to be around 3 times larger than that owed to Chinese lenders. This crucial detail often gets lost in the prevailing debt trap narrative, which tends to disproportionately focus on Beijing's role, thereby obscuring the broader and more complex web of international finance that African nations must navigate. A persistent concern surrounding Chinese loans, irrespective of their size, is the pervasive lack of transparency. Many loan agreements are notoriously opaque, often containing confidentiality clauses that prevent public disclosure of their terms and conditions. This absence of public scrutiny makes it exceedingly difficult for citizens, civil society organizations, and even parliamentary bodies within African nations to assess the true cost of these loans, the fairness of the terms, or the potential long-term implications for national sovereignty and financial stability. Such opacity inevitably raises serious governance concerns and can foster an environment where accountability is diminished. The burden of debt servicing is further compounded by a confluence of global economic factors. The economic slowdown induced by the COVID-19 pandemic, coupled with rising global interest rates implemented by central banks to combat inflation, and the economic repercussions of the war in Ukraine, have all contributed to a more challenging financial environment for developing countries. These external pressures exacerbate the difficulty African nations face in meeting their repayment obligations to all creditors, not just China, pushing some closer to fiscal distress and necessitating difficult choices about public spending and economic priorities for the foreseeable future. The popular notion of China systematically employing a debt trap to seize African assets upon default, while compelling, finds limited support in empirical evidence. Actual instances of China taking control of major state assets due to loan defaults are rare. More commonly, when countries face repayment difficulties, Beijing has shown a willingness to engage in debt restructuring, reprofiling, or even partial forgiveness, albeit often on terms that remain largely undisclosed. This suggests that China's primary motivations may extend beyond simple asset acquisition, encompassing broader strategic goals, such as securing long-term resource supply chains, cultivating political alliances, and expanding its global influence. Chinese lenders and corporations clearly derive substantial benefits from these engagements. The initial wave of large infrastructure projects provided guaranteed contracts for Chinese construction firms and created markets for Chinese goods and services. More recently, even with the shift to smaller projects, the focus often aligns with China's strategic needs, such as securing access to critical minerals like lithium, which are vital for its burgeoning green technology sector. Chinese mining companies have invested billions in African lithium mines, securing a significant share of global capacity, sometimes with attendant concerns about local social and environmental impacts, ensuring a steady flow of raw materials back to Chinese industries. Simultaneously, African elites continue to find these arrangements advantageous for their own purposes. The ability to deliver tangible infrastructure, even if financed by debt, can bolster political legitimacy and demonstrate effective governance to domestic audiences, at least in the short run. Access to Chinese capital, often with fewer governance-related conditionalities than Western alternatives, provides leaders with greater autonomy in pursuing their development agendas, or in some cases, personal or partisan objectives. These projects, regardless of their ultimate economic success or failure, serve as powerful symbols of progress and can be instrumental in maintaining political power and patronage networks. In conclusion, the relationship between Chinese lenders and African nations is far more nuanced than the simplistic debt trap label suggests. It is a complex interplay of mutual interests, where both sides strategically leverage the arrangements to achieve their respective economic and political goals. While genuine concerns about debt sustainability, transparency, and the long-term impact on African economies persist and must be addressed, the narrative needs to encompass the agency of African leaders and the multifaceted benefits that accrue to both Chinese entities and sections of the African elite, often leaving ordinary citizens to bear the ultimate risks and costs.